The S&P 500 fell 1% today as it was grappling with a rising case count for COVID-19. We also saw the inflation numbers come in a little bit lighter than what the market wanted. So we're going to take a look at that. We'll also look at some activity between market cap weighted and equal weighted sectors. And then we'll get into our trade application example where I once again focus on a technology stock that seems to be falling out of favor for a bearish trade idea. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 12th, 2020. First of all, if you're new, welcome aboard. Remember to go over to our YouTube channel, click subscribe. While you're over there, check out our email distribution list area in the description area down below. That'll entitle you to notifications whenever we post these videos, and also gives you a heads up as to what stocks are giving you overbought and oversold cluster signals in the S&P 500. In addition to that, we are heavy users of Twitter. Feel free to follow me. My handle is @BrandonVanZ, and I really appreciate those of you that click like and retweet on these Market Outlook related tweets. And last but not least, we have a presence on Facebook. Feel free to join our group at that web address you see embedded in the logo in front of you. All right, let's go ahead and jump into the activity here today. And as you can see, I got chart 6D pulled up here in front of us. A reminder that I typically will look at this chart if we have a market move of 1% or more. So today we had exactly that 1%. You can see the S&P 500 was down 1% to the decimal. So it doesn't happen very often, but you can see what that does is it causes this effect where the red bar goes exactly to that blue horizontal line there and just stops. And so this is our first 1% or more down day since October 30th, which you can see what that candle looked like right there. And so in other words, this is the first larger type of a sell-off that we've had since the presidential election. You can see that for the most part in the last couple of weeks, we've had large days, but they've almost always been of the variety of large up days. And so today was a little bit of a rarity where we kind of gave a lot of that back along the way. Now you can see what that has done to the chart up above as far as the S&P 500. In other words, not much. It doesn't even register for the most part on the chart. It's kind of a blip, so I wouldn't read too much into it. Perhaps there is something worth noting that we're kind of up at a resistance area, so it's not that this can't lead to something a little bit more sinister down the line, but as of this exact moment in time, there's not a whole lot of worry at this level. So we'll keep our eye on it. You can see that the VIX rose. I know it's probably hard to see that here, so let me kind of drag this into our view a little bit. This little bounce higher here in the purple line down below signifies that the VIX did rise today up to 25. Remember, the VIX itself is a percentage, so it's kind of hard to report it in percentage terms, but if you were, it was up about 8% today. So it was a pretty decent day for the VIX, and of course, remember that the VIX and the market itself are often inversely correlated. However, the VIX was recently up here above 40 just before the election, so the fact that it rose today needs to be taken into consideration in context as to where we've been previously. Let's go ahead and see how the breadth of the market did today. So I'm going to come over here to the Market Watch tab. Let's go to the Visualize area. Let's go over here to the indices. Actually, you know what? I'm going to hit the Visualize drop down, and instead of looking at the heat map, let's look at the Index Watch instead. And then just to the right of Index Watch, it says Watch List. I'm going to click on that. I'm going to come down here to Public, and I'm going to find the S&P 500, and I'm going to click on that. And you can see here that it was quite the ugly day in terms of market breadth. In fact, it's a little bit uglier than even I had assumed. I knew today was a down day, but I didn't realize it was this one-sided. You can see that the declining stocks easily dwarfed the amount of advancing stocks. Declining stocks, out of the 500 stocks in the S&P 500, 443 of them went down today. Only 59 of them rose today. So a bit of a give back from some of those really nice gains that we had earlier this week. Let's take a look at some charts, and I'm going to pop over here to chart 4B. to give us a sense of what, if anything, today's movement has meant from a market posture perspective. So remember, on chart 4B here, we're simply looking at a 4-grid that will give us an idea with the 4 U.S. Equity indices, the major ones at least, and we can kind of see them all next to one another to see if there's any differences between them. And right now there are. We saw some reasonably big difference here today as a result of what happened in trading. You'll notice that the S&P 500 and the NASDAQ Composite now both have this pink background color over today's candle. And what that signifies is we now have a weekly bearish posture on those two indices. Now remember, don't read too much into it because we are still trading above rising moving averages. So notice that the moving averages are still colored in green as opposed to any other color. So the path of least resistance continues to be to the upside, but it is also possible that we've kind of reached a bit of a stalling out point as well. And you can see that the markets have largely just been chopping up and down from more of a sideways perspective here in the last, let's call it 2 months or so. So is it a reasonable possibility that we start rolling over here on the S&P 500? Sure. I don't think that's out of question at all. Whether we do or not is anybody's guess, but I don't think this is a game changer type of a moment in time right now just because the market is down 1%. I mean, theoretically, the S&P 500 could come down here to 3,300, bounce from those levels, and still stay within that sideways range that we've been experiencing, and it doesn't have to mean disaster moving forward from that point in time. So there are times where you just have to kind of wait and see, right? There's markets aren't trending all the time. Markets spend quite a considerable amount of time along the way just drifting sideways, and it's possible that's kind of the mode we're in right now. And like I mentioned before, same thing down below here with the NASDAQ Composite. And remember, that's not David and I coloring the background of those charts. That's happening anytime we have a posture change using the rules set forth on the market forecast technical indicator. So the reason in this particular case we saw that color change from green to pink is the green intermediate line, which is our default line to set our posture in this presentation unless we say otherwise. The green line fell out of the upper reversal zone today. So notice if you were to read the label here where it says intermediate 79.13 and falling, yesterday it was above 80, in other words, in the upper reversal zone, so we would have considered it bullish yesterday. Now that it fell below that upper reversal zone, it is now considered weakly bullish. But because it's so close to that upper reversal zone, keep in mind the possibility that it could easily flip back to bullish starting tomorrow. Right? The further away that green line is from the upper reversal zone, the greater the chance that wouldn't happen. But in this case, since you're basically just hanging on by a thread right at that same level, you could be back in the upper reversal zone easily tomorrow under the right set of circumstances. In fact, I just retweeted something from Ryan Detrick on Twitter. He was saying that tomorrow's Friday the 13th, and a lot of times people get a little nervous trading on Friday the 13th, but the last time we had Friday the 13th was earlier this year in the middle of March, and the markets rallied like, I don't know, he said it was like 7 or 8% or something like that. So it must have been one of those huge dead cat bounce types of days that we were experiencing back in the spring. So who knows? Maybe we get a big rally on Friday the 13th again tomorrow. And if that does happen, then we could easily revert back to that bullish posture. But it's just a sign that, hey, there's been a little bit of wear and tear. We haven't seen a big advance or progress. And the other two charts on the right-hand side, we haven't given back enough in this 2-day pullback to implement a posture change yet. The Dow Jones is almost there. The Russell 2000 has been our leader and would not have a posture change anytime soon in all likelihood. So notice that the Dow Jones, we have our green line or the intermediate line at 81.36 and falling. So notice that the green line is just barely in the upper reversal zone on that one. and notice the difference between that and the S&P 500 where the green line has fallen out of the upper reversal zone. So likewise, we are hanging on by a thread to the upper reversal zone there. If Friday the 13th tomorrow happens to be a horrible day for the market, you could easily see the Dow Jones Industrial Average follow both the S&P 500 and the NASDAQ Composite with a weekly bearish posture. But no matter how bad tomorrow is, I personally do not anticipate that the Russell 2000 will switch postures as soon as tomorrow. It's not to say that it can't happen next week, but I would not expect it to happen tomorrow. You'll notice that you have a lot more wiggle room with the Russell 2000 because it has been our leadership area. Notice that the intermediate line on the Russell 2000 is at 90 and falling. In other words, it would have to fall 10 whole points before it would fall out of that upper reversal zone on the intermediate line. So that one we should be good to go going into the weekend with a strongly bullish posture. I would also point out that speaking of the Russell 2000, we do have what's known as a bullish intermediate confirmation signal on this one right now, and that occurs when we've got the green line in a bullish territory, which it is in the upper reversal zone currently, and on the exact same day having the red line in the lower reversal zone, or that momentum line there, and that is where we find ourselves right now. You'll notice the momentum line is at 12, and so technically you do have bullish intermediate confirmation signals on both the Russell 2000 and on the Dow Jones Industrial Average to close out today. So we'll see where that takes us. The blue line on the Dow Jones Industrial Average, by the way, is between 20 and 50, where we oftentimes like to look for that because it's a little bit more of a give back. Remember, the bullish intermediate confirmation signal is effectively a buy the dip signal. So you want to have a nice healthy inhale and exhale along the way. With the Russell 2000, its blue line isn't quite below 50. It's close. So this is about the type of thing you're looking for, but you might need a little bit more of an exhale there on the Russell 2000, whereas you've gotten a little bit more of that sell-off on the Dow Jones. Notice that the Russell 2000 just hit an all-time high yesterday. And remember, that was a pretty big event when we've been hitting new all-time highs on the Russell 2000 this week, because the Russell 2000 was the one out of these four indices that for the last several years did not hit a brand new all-time high. It has been only recently that the Russell 2000 has taken a leadership role. In fact, that's been a conversation that we've been concentrating a lot on in my factor-based swing trading class that I teach on Wednesday mornings for premium and plus members of Market Scholars. Over here on the internet, real quick, you can see my factor selector. And we've been recognizing this outperformance in the low size factor really since it bottomed out here the first week of September. There you were second to last. It moved all the way up here to third from last. Then it moved all the way up here to the second best. And then 2 weeks ago, we actually saw it take over the top slot. That was one kind of fun thing that took place here. Most of you are aware of the seismic shift in money that took place on Monday and Tuesday of this week, where we saw this huge movement of money from momentum stocks into value stocks. Lots of people were talking about it. I spent a lot of time on the video on Tuesday talking about it. But what was fun about it from my factor-based swing trading classes perspective is we already had a heads up that that was taking place. You'll notice that momentum, which is this purple ball and line that you see here, momentum was number one on October 27th. And it had been number one for weeks and weeks and weeks and weeks. I mean, there was no other factor that seemed to have enough strength to knock momentum off of its perch. But last week, we got a heads up. And again, this happened prior to the big move that all of us recognized on Monday and Tuesday of this week. So last week, we already had a heads up that momentum was falling out of favor as it slipped from number one down here to number 4 on November 3rd. So that was 9 days ago. And so it wasn't a big surprise that when I tallied this up again here on the 10th, that we saw a further slippage in momentum, because this metric that I put together here on the 10th would have included this Monday and Tuesday. So this was a really neat opportunity for me to share with my Premium and Plus members of Market Scholars that, hey, batten down the hatches, there is something sinister happening below the surface when it comes to the momentum factor itself. We had a 1 week advance notice of what ultimately happened on Monday and Tuesday. So in its place is now size. And remember, size had been working its way up the rankings for several months. So this is not something that is happening out of the blue. We've witnessed it and we've recognized it along the way. And so when we are now starting to see that the Russell 2000 compared to things like the S&P 500 and the Dow Jones Industrial Average and the NASDAQ Composite, the Russell 2000 of all the small cap and small size companies is outperforming, it clicks, it makes sense. That is one of the hot areas to be right now. So anyway, we'll see where that takes us going forward, but I do like that activity that we've been seeing in those low size stocks ever since the beginning of September, and now we have an all-time high in the Russell 2000 as kind of a feather in our cap for those of us that have been following that low size factor higher over the last 2.5 months. While we're over here on the internet, I always like to have an opportunity to say thank you to those of you that help support David and I here with these videos. The best way that you can do that is by clicking like for us on Twitter. And I always strive to get 100 or more likes. This last time around, 109. So thank you to all of you that come out and support us each and every time. The way that I think of it, remember, we don't make any money doing these free promotional videos here. So David and I need to have the proper motivation in order to spend 2 hours out of every trading day to do these videos. And so, you know, as long as we're getting 100 or more likes on Twitter, I think it's worth our time to do it. If we're getting less than 100 likes on Twitter, then we have to really wonder whether we're making a positive impact on you guys that are listening to the videos or not. You know, and it comes down to what is our motivation to doing the videos themselves. If we're getting over 100 likes, then I'm going to make it a priority in my day and make sure it gets done. If we're getting less than 100 likes, then, you know, things like doctor's appointments and dentist's appointments and other business meetings might start taking priority over these YouTube videos. So if you want to see these videos continued, the best way that you can help encourage David and I to do that would be to click like for us there on Twitter. Also, earlier today, we had a great session in terms of the question and answer session that I host every Thursday morning for our students. And so feel free to check out that recording once it becomes available. David is going to be teaching his very popular technical analysis class tomorrow at 1 p.m. Eastern Time. And I'm sure he'll share some thoughts on his presentation that he's making tonight. Many of you know that David is a chartered market technician. And so if you've ever wanted to learn technical analysis from a true pro, I can't think of anybody better in the business than David Settle to do that. And tonight he's actually giving a presentation to the Chartered Market Technician Society of Washington, D.C. So he's speaking to other professionals, other peers about his topic about what to expect in this post-election world that we're in right now. So for those of you that want to have that close association and ability to learn directly from one of the best in the business, then you have that opportunity here at Market Scholars every single Friday during David's outstanding technical analysis trading room. All right, let's get back on track with a few more charts here. I'm going to come over here and I wanted to spend a little bit of time looking at some 12 grid analysis in a kind of a compare and contrast mode. So I'm going to show you the U.S. sectors, chart 5C. Now this first set of 12 grids right here is going to be kind of the more traditional way to look at sector analysis in the United States. So if you just hear people broadly speaking saying, so-and-so sector did this or so-and-so sector did that, they're usually looking at it from this particular approach here. In fact, earlier today on CNBC, I heard them say all sectors finished lower. Now, they didn't qualify that and say which sectors were they looking at, but this is kind of what they're referencing. All of these ticker symbols that start with the letter X, like XLF, that stands for the financials, XLC, that stands for the communication, XLK represents technology in this case, and so on and so forth. Those are your select sector spider ETFs. They kind of had the early mover advantage. They were some of the very first ETFs that tracked sectors, and they track all the stocks in the S&P 500. So if you chopped up the S&P 500, each stock has one and only one sector that it can belong to, and it's part of these 11 sectors that you see here. Remember, this is a 12 grid because I've got the S&P 500 in the upper left, but all the 11 other squares that you see are the sectors. So the way that this works is it is showing extra emphasis to the biggest companies. So one key area where you can see the big difference right now from my perspective is discretionary. Notice that discretionary, and that's your chart kind of in the middle rung toward the left-hand side here. Notice that discretionary is kind of sitting in that pink background color, and notice the placement of the candle right now is sitting basically right on top of that 30-day moving average. Now remember, we have another grouping of sectors that those of you that are premium members can pull up via a 12 grid as well. And those ones would be known as equal weight sectors. So this one here with XLY representing discretionary stocks, it is dominated by Amazon and Home Depot. In fact, I think they even show that on the Thinkorswim platform now somewhere. Give me a second and I'll try to pull that up. Let's see, XLY. And I think it might be under the Analyze area somewhere. Yeah, here it is. And you can see how important Amazon is to XLY. It's really not even close. You have Amazon and Home Depot and then everybody else. Amazon represents literally a fifth of the entire XLY. That's how big Amazon is because its market cap is absolutely enormous. It's basically $1 trillion company, right? And so Home Depot is probably about a $500 billion company because it's representing about half of that. Those numbers might be a little bit off, but the point that I'm trying to make is that if you were to add Amazon and Home Depot together, it's representing literally 1/3 of the entire XLY. So when you're looking at something like, a broad term of, hey, how are the discretionary stocks doing? And you're looking at XLY, effectively what you're saying is, how are Amazon and Home Depot doing? And sometimes that doesn't give the most crystal clear picture of what's actually taking place with, in this case, the discretionary stocks. So one thing I wanted to point out here today is that when we're looking at this market cap weighted 12 grid here, notice that there are only 3 green charts on the board. Okay, so we're looking at financials, energy, and staples. That's it. Now, if I were to show you a slightly different way of looking at the sectors, I'm going to come over here to chart 5R. That's our equal weight sectors 12 grid. Notice that we go from 3 green squares to most of them being green squares in this view, even though we're looking at the exact same sectors. The difference being whether those sectors are considered market cap weighted, like the traditional approach that I just showed you a moment ago, versus this approach right here where we have equal weighting. In other words, each one of the companies that are represented within these ETFs have an approximately equal weighting to one another. So in the case of like consumer discretionary, Amazon would have approximately the same weighting within that fund as something like Gap stores, as just one example. I'm trying to think of a smaller retailing type of a company. So in this case, you'll notice that it does make a bit of a difference here. Notice that discretionary is not touching its 30-day moving average when you look at ticker symbol RCD, which is the equal weight version of it. Here, it looks a bit healthier. On the XLY, it's looking a little bit more disturbing there because it could very well start breaking support levels. Here you're seeing RCD just come down to the prior resistance area, and we're not even close to touching the moving average yet. So what that tells me is that the average consumer discretionary stock is actually doing better than what meets the eye when you're just simply looking at XLY. It's probably telling me that stocks like Home Depot and Amazon are struggling a little bit on a relative basis at this exact moment in time, and a lot of those other smaller retail stocks like L Brands or VF Corp or Gap and all those types of retailing companies on the whole are actually starting to firm up a little bit more as we head into the holiday shopping season. And remember, Amazon is oftentimes lumped into like kind of the coronavirus play, e-commerce. And so with that falling out of favor earlier this week, and money kind of rotating into the reopening economy, that should start making sense in your head why all of a sudden RCD looks better than XLY. So remember, if you are a premium member of Market Scholars, make sure that you're thinking in those terms. And remember, when I do the sector selector each weekend, that is based off of this philosophy, an equal weighted philosophy. It's giving us a truer sense of kind of broad performance within those sectors, and it's not as reliant upon only the giants of the world out there, because there can be times like we are experiencing right now where we are seeing a distinct difference between that. And it kind of plays into what I mentioned earlier as well about smaller companies doing a little bit better than larger companies on the whole through the lens of the Russell 2000 doing better than the Dow Jones Industrial Average, as just one example, or the S&P 500, however you want to think about that. And so if you think about kind of the compare and contrast of equal weight versus market cap weight, that is playing through here as well. It's basically saying that the smaller companies within the sectors are generally holding up or doing better on a relative basis than the larger companies are, everything else being equal, which is why when we looked at the other 12 grid, we only saw 3 green charts on the board. Here, it's almost the opposite. Here we have 4 pink charts on the board, and most of these charts are green. So in terms of market breadth, I think that's actually a positive sign. It's not just the generals that are attempting to lead this market. We are seeing lots more participation among some of those forgotten about areas of the market previously. Okay, so I think that's a positive sign. Let's get into our trade application example now. And for that, I'm just going to pull up a normal market forecast 1 grid. Now, a friendly reminder that, remember, I place these trades before the market closes, and then I send out the Telegram app to alert you of that. And remember, if I'm ever going to be making changes within the portfolio, I also send out the Telegram, and that's exclusive to premium members of Market Scholars. In fact, earlier today, we had kind of an interesting situation with PCG. I had almost forgotten about this trade, to be completely frank with you. We placed a swing trade on PCG in this presentation back in September. This is PG&E, the electric utility out in California. And I think it was on this day right here when we got into it, and we broke above that horizontal resistance area. And so we had a one-for-one good till cancel order, or one cancels other good till cancel order, however you want to say that. Basically, we had a situation where we bought the stock, and we had an upside price target and a downside stop loss. And normally when I do swing trades, like I tell my Wednesday morning class, I only anticipate being in the trade for 3 weeks or less. So that's what makes this one a little bit strange. We actually had to be in this trade for 2 months, which is much longer than the typical swing trade. But we were able to hit our max gain price target, and because the order was already established in advance, we're already out of it. So we took max gain on that trade. So remember, it's fairly rare for me to be placing trades in between presentations, But in a case like this, where trades were already established ahead of time, for those of you that are premium members of Market Scholars, make sure you're checking in regularly on the Telegram app where I'll be alerting you of that information. But anyway, back to the matter at hand with today's trade application. I went with VeriSign. This is ticker symbol VRSN. This is a stock that was popular back in the mid-aughts, back in like 2004, 2005. It strikes me as a company that had its heyday back then. It's basically an internet registrar, and they do have some Modi characteristics. But like all companies, they go through good periods and bad periods in terms of how the stock market views their stock price. And so what I did in this particular case was another bearish trade idea on an older technology company, right? This is not one of these new up-and-coming cloud stocks or Zoom Video or the types of companies that are benefiting from the coronavirus. So it's somewhat similar to what I did on Tuesday. And I might add that IBM bearish trade that we did on Tuesday is already looking pretty good. Notice how the posture on that IBM chart has gone from bullish to bearish today with the big bounce down. So far so good on that bearish trade that I placed on IBM on Tuesday. And so VeriSign kind of reminded me of the same type of a situation. It's not exactly an overlay here, but moving into bearish trades in the technology sector. Remember, part of the thesis for doing that trade on IBM was that we were seeing technology on a sector perspective falling down the rankings on an intra-week basis. And we'll find out for sure tomorrow when I produce the sector selector whether that holds up or not. But in this case, it kind of follows the same type of theme. And you'll notice here that VeriSign was down 1.45% here today. And it caught my eye because of where it is struggling. You'll notice here that VeriSign very clearly has three different levels of kind of lower highs on the chart, right? You topped out back here on September 2nd, just above 220. Then you kind of fell apart. You went back up, and it topped out this next time at around 215 here in mid-October. You fell down and breached that prior low, thus completing that pattern of lower high, lower low. We had this reversion to the mean type of a move here over the last couple of weeks, and then the highest we got to this time around, let's call it around $210. So once again, struggling. Now, if that pattern is going to hold of lower highs and lower lows, then what it's basically saying is that we should maybe anticipate that we breach $187 on the low side. So we'll see if that happens or not. Like any trade setup, it's subject to being incorrect and wrong, and also subject to any random headline or news item that will drive the market in the opposite direction. So that's what options allow you to do. They allow you to control your risk. And so in this case, I'm not just shorting the stock outright. Instead, I'm doing what's known as a long put vertical spread. Now that is a debit spread. In other words, it's one where you have to pay money out of your pocket. And the way that we teach them here at Market Scholars, it is a directional trade. Remember, another possibility could have been that I would sell a bear call spread. And it's not that that would be a terrible idea. Remember, there's a lot of benefits to that as well, where you make money off of time decay and you have a high probability of success. It's just that your reward possibilities are very limited with that type of a trade. So what I opted to do in this case is a little riskier, where my probabilities of success are not as strong, but my upside potential is much greater than had I done a bear call spread. So in this case, where I'm buying a put spread, it is directional by nature, and I need this stock to go lower. This blue line on the chart here represents where my break even is on that particular trade. And so we're pretty close to it already. In an ideal world, what I want is for this stock to close below 195 on expiration day there in December. So if you need the trade details, including the strikes, the time period, and the fill prices. That's what is available to our premium members on the Telegram app that I mentioned before. But I'm looking at VeriSign right now as kind of a bearish setup, as a bounce down and off of a falling 30-day moving average, where we also saw a posture change in the last couple of days, where we went from bullish to weakly bearish to now strongly bearish as a result of this drop in price that we experienced here today. And you can kind of see that green line rolling over here on the market forecast chart as well. So that's what I had for you here today. If you got value out of this conversation today regarding the difference between market cap weight and equal weight and what that can mean to your analysis, I would encourage you to click like for me there on Twitter. Remember, it only takes you 5 seconds to help support this video. It takes David and I 2 hours to get all of the prep and the research and the notifications and everything that goes into it. So if you want to help support the video, that's all you have to do. Click like for us there on Twitter. Remember, David's got his excellent technical analysis class coming up tomorrow, and then I'll see you guys all next week. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.